Welcome to G Fun Facts Online. Today, we're diving into the world of high finance, exploring a market that's as notorious as it is essential. What if I told you there's a multi-trillion-dollar market built on what many people call junk? We're talking about high-yield corporate bonds, or as they're more famously known, junk bonds. These aren't just risky bets. They are masterpieces of financial engineering that fuel innovation, fund corporate giants, and offer tantalizing returns. So let's peel back the layers on the allure of high yield and understand the engine room of corporate finance. The story of junk bonds is a true phoenix from the ash's tale. While lending to risky businesses is as old as commerce, the modern high-yield market really got its start with something called fallen angels. Imagine a big, stable, blue-chip company. Its bonds are investment grade, meaning they're considered very safe. But then, the company hits hard times. Its credit rating plummets, and suddenly its bonds are shunned by mainstream investors. These were the fallen angels. In the mid-20th century, a few clever investors realized the market was overreacting. They saw that the prices of these bonds were pushed far below their real value, causing their yields, or the return they paid, to skyrocket. They saw opportunity where others saw only risk. But the real explosion happened in the 1970s and 80s, thanks to one man and his firm, Michael Milken of Drexel Burnham Lambert. Milken's genius was realizing there was a huge untapped universe of companies that weren't fallen angels. They were just inherently non-investment grade. Think of young, disruptive companies in new industries like tech, or solid companies in cyclical sectors that banks just wouldn't touch. Milken didn't just find this market. He created it. His team at Drexel developed sophisticated methods to analyze these companies' creditworthiness and built a network of investors bold enough to buy their bonds. This was revolutionary. It democratized access to capital, unleashing a wave of corporate growth. The high-yield market soared from just $10 billion in 1979 to nearly $190 billion by 1989. It became the primary tool for a new, aggressive form of corporate finance, the leveraged buyout, or LBO. However, this Wild West era had its excesses. The market became linked in the public mind with hostile takeovers and corporate greed. The savings and loan crisis of the late 80s, where many S&Ls had invested heavily in these bonds, and the eventual downfall of Drexel itself in 1990, led to a temporary market collapse. But you can't keep a good idea down. The market re-emerged in the 1990s, more mature and institutionalized. It was no longer the Wild West, but an established part of the global financial system, financing the dot-com boom and proving its resilience through multiple economic crises, including the 2008 crash. So what makes these bonds tick? At its core, a high-yield bond is an IOU from a company. But to attract investors to riskier businesses, these IOUs are finely tuned with special features. This is financial engineering at its best. The most critical part is the bond's legal document, the indenture. Inside, you find the covenants. Think of covenants as the house rules the company must follow for the life of the bond. They are far stricter than for safer, investment-grade bonds and are designed to protect bondholders. For example, a limitation on indebtedness covenant restricts how much more debt the company can take on, preventing it from becoming over-leveraged. A limitation on restricted payments covenant limits how much cash can be paid out to shareholders as dividends, ensuring money stays in the business to pay its debts. Other key covenants limit asset sales, prevent shady deals with affiliated companies, and include a change of control put. This last one is fascinating. It gives bondholders the right to sell their bonds back to the company, usually at a premium, if the company gets taken over. This protects them from a new owner with a riskier strategy. The negotiation of these rules is a delicate dance between protecting investors and giving the company flexibility. In recent years, we've seen a trend of covenant-light bonds, which have weaker rules. This is usually a sign that investors are so hungry for yield that they're willing to accept more risk. Next, we have call provisions. This is essentially an escape hatch for the issuing company. A callable bond allows the issuer to buy back, or call, the bonds before they officially mature. Why would they do this? If interest rates fall or the company's financial health improves, it can refinance its debt at a much lower cost. Of course, this isn't great for an investor who is enjoying those high interest payments. To compensate, these call provisions have rules. There's usually a no-call period of a few years where the bonds can't be touched. After that, the company has to pay a premium to call them, and that premium decreases as the bond gets closer to its maturity date. This brings us to the pecking order of repayment, officially known as security and seniority. This determines who gets paid first if the company goes bankrupt. A secured bond is backed by specific collateral, like a factory or real estate. Holders of these bonds have a direct claim on those assets. An unsecured bond is backed only by the company's general promise to pay. Most high-yield bonds are unsecured. Seniority refers to the priority in the repayment queue. Senior debt gets paid before junior, or subordinated, debt. In a bankruptcy, senior bondholders must be paid in full before subordinated ones see a penny. Most high-yield bonds are issued as senior unsecured debt, meaning they rank below any secured loans but above subordinated debt. And, of course, stockholders who are last in line. There's also a subtle trap called structural subordination. If a bond is issued by a holding company that owns several operating businesses, the creditors of those operating businesses get first dibs on their assets and cash flows. The holding company's bondholders are structurally subordinated, getting access only to what's left over. The world of high-yield debt is also incredibly diverse. Beyond the plain vanilla bond, you have exotic instruments. There are payment-in-kind, or PIK bonds, where the issuer can pay interest with more bonds instead of cash. Great for a cash-strapped company, but riskier for the investor. Zero-coupon bonds pay no interest at all. Instead, they're sold at a deep discount and pay back the full face value at maturity. The investor's return is the difference. This variety allows financial engineers to tailor instruments to the exact needs of both companies and investors, making the market incredibly dynamic. This brings us to the ecosystem itself. The companies, or issuers, of high-yield bonds are a diverse bunch. They include young, high-growth tech or biotech firms with great potential but no long profit history. They include companies that are highly leveraged, perhaps after a big acquisition. They include companies in cyclical industries like energy or manufacturing, whose fortunes rise and fall with the economy. And of course, there are the fallen angels we mentioned earlier. For all of them, this market provides capital they likely couldn't get elsewhere. On the other side, you have the investors. The biggest players are institutions. High-yield mutual funds and ETFs are the most common way for everyday people to invest, offering diversification across hundreds of bonds. Then you have the more aggressive players, hedge funds and specialized distressed debt funds. These funds often focus on companies that are in or near bankruptcy, hoping to gain control during a restructuring and profit from a turnaround. More conservative institutions like insurance companies and pension funds also allocate a slice of their portfolios to high-yield bonds to boost their overall returns. And of course, the whole market is made possible by intermediaries. Investment banks are the architects. They work with companies to structure the deals, underwrite them by buying the entire issue and taking on the risk, and then sell the bonds to investors through a process called a roadshow. And then there are the credit rating agencies, Moody's, Standard & Poor's, and Fitch. They assign the ratings that officially define a bond as investment grade or high yield. A bond is considered junk if it's rated below Baa3 by Moody's or BBB by S&P and Fitch. These agencies are powerful, but also controversial. Their issuer pays model, where they are paid by the very companies they rate, creates a potential conflict of interest, leading to accusations of ratings inflation in the past, most notably before the 2008 financial crisis. So with all this complexity, How does one navigate this landscape? Investing here is not for the faint of heart. It starts with rigorous credit analysis. This is where investors become detectives, going far beyond the credit rating. They perform a deep dive into the company's financials. The number one thing they look for is liquidity and free cash flow. Free cash flow is the money left over after a company pays all its operating expenses and capital expenditures. It's the lifeblood that shows a company can truly afford its debt payments. Analysts also scrutinize the debt structure, how much debt there is, when it's due, and where it sits in that seniority pecking order. They also assess the business model and its competitive position. Is this a company with a strong moat, or is it vulnerable to competition? And finally, they look at the management team. Is the leadership experienced, with a clear, credible strategy? After the analysis comes valuation, or putting a price on risk. The most common method is discounted cash flow analysis, where you project all future payments from the bond and discount them to today's value. The key is the discount rate. For high-yield bonds, this rate must be high enough to account for the significant risk of default. Investors also use relative value analysis, comparing a bond's yield to its peers to see if it's cheap or expensive. And crucially, they perform recovery analysis. This means estimating how much money they would get back if the company defaulted. A bond from a company with valuable assets might have a high recovery rate, making it less risky than its yield might suggest. Of course, the risks are very real. The biggest is default risk, the chance the company simply can't pay you back. Then, there's interest rate risk. If overall rates rise, the price of existing bonds falls. High-yield bonds are also subject to liquidity risk. In a panic, it can be very difficult to sell them without taking a big loss. And finally, economic risk. High-yield bonds are very sensitive to the health of the economy. In a recession, default rates typically spike. As we look to the future, the high-yield market continues to evolve. One of the biggest trends is the growing importance of environmental, social, and governance, or ESG, factors. More investors want their money to do good, or at least not do harm, and are demanding bonds from companies with strong ESG credentials. This is pushing issuers, even smaller ones, to improve their transparency and performance in these areas. The macroeconomic environment, especially interest rates and the threat of recession, will always be the dominant force shaping returns and defaults. Ultimately, the future of the high-yield market will be driven by the same forces that created it: the endless need for capital from innovative and ambitious companies, and the timeless appeal of high returns for investors who are willing to do their homework and take a calculated risk. In the grand tapestry of corporate finance, these so-called junk bonds are an essential thread, a powerful testament to financial engineering's ability to connect risk with opportunity.